It can be hard to make an appraisal interesting to talk about, I think. Many times when you're involved with a transaction of purchasing a home or selling a home, it's really the only time you're going to hear about an appraisal. Of course, refinancing, if you got to get money out, there's a couple different times, but unless you're involved with a housing transaction of some kind, you're not really going to be super interested about talking about appraisals. Appraisals are one of those things that come up really only when you're looking at a housing purchase or sale or refinance. Something with the house, right? You can do a comparative market analysis. You can do different things like that. You can have an idea. You can go to Zillow. You can take a look at your house value. We're all interested in how much our house might be worth. And some people I know will go to Zillow on a daily basis, but that's not always the case. So when you're looking at an appraisal, that is something that's certainly going to be involved with the home purchase. Many times the buyer is going to be the one who is most concerned, and the seller too, but the buyer wants the appraisal to come out many times, specifically Silicon Valley, many times other places also, because they're in contract. And if they have an appraisal contingency, their purchase of that property is contingent on that appraisal appraising. If you like the videos that I have here, if you like the channel, please like, subscribe. This is going to be about appraisals, for better or worse. And there's different types of appraisals. The appraisal that I'll be speaking about is going to be the appraisal for a home. When somebody purchases a home and someone is selling a home, if you're purchasing a home, you're going to have an appraisal done. Unless you're writing a check or sending a wire of all cash to purchase this home, an appraisal will be done by the lender. That appraisal might be a quick appraisal. That appraisal, if you're putting down 50%, depends on the lender. There's a lot of different criteria that you look at there, but if you're putting down a larger amount, then the appraisal process will be quicker. They can get a desktop underwriting appraisal, and that just means that they're going to take a look and they'll do a drive-by appraisal, and that drive-by appraisal just makes sure that the building or the structure, the home, is still standing. Many times that specifically happens fire season or during flood season and things like that. It's all the time, but that's the main criteria for it. So when you're putting down a larger amount down, and it depends on the bank, many times it's going to be 40%. Some programs will allow it with less down, and they will allow you to do the loan, do the appraisal with less down, but they'll do that same desktop appraisal and a drive-by appraisal by an appraiser to make sure that the structure is still there. An appraiser is a neutral third party. Back in 2010, this is actually when that changed. Up until that point, the appraiser was a third party, but not so much neutral. Up until 2010, the appraiser was with a relationship with the loan officer many times, the loan officer or maybe the realtor. And so the appraiser would go out and the appraiser would appraise the property. The appraisers do have a license, and they have to go through a long process to get their license, and they do really cherish their license, just like any realtor does. Any realtor that I know, we cherish our license. We want to make sure that we're doing everything to the letter of the law, and we want to make sure that we're doing everything ethically to make sure that our fiduciary responsibilities are covered to protect our clients' best interests. And up until 2010, when the Frank-Dodd Act actually was implemented, there was the ability for someone to order the appraisal, and even the buyer could order the appraisal, or if somebody's doing a refinance, if they needed an appraiser, they could have the appraiser come out. And what happened was there was some undue pressure on the appraisers to make sure that the property came in at value, so to speak. Now, when an appraiser does an appraisal on a property, they are going to take properties that are like the property that's a subject. So if you're purchasing a 4-bedroom, 3-bath home, or a 2-bedroom, 1-bath condominium, they can't go look at a home that's a 2-bedroom single family because it's not a comparable property. If that single family home happens to be out in the middle of nowhere, then that's going to be a rural type of a scenario, and they're going to have to extend out further. An appraiser is typically going to stay within a half of a mile and find the most recent sales within 6 months typically, and they're going to use within the 6 months, a half mile, the most comparable property. So you're going to look at a 4-bedroom to a 4-bedroom, and that 4-bedroom to a 4-bedroom is going to also be given credit or credit taken away, and those credits can go different directions. That 4-bedroom might have more updated, more upgraded countertops, so that's going to be a strike against the one that they're doing the appraisal for, or vice versa. Or the 4-bedroom that they are doing the appraisal for is more updated and has bathrooms that are updated, has a kitchen that's updated. They're going to take take that into account and they're going to give more credit to that. So that's how the appraisal works. And ultimately what they're doing is they're going to find at least 3 to 4 other properties that are similar. And many times for us, when we're looking at specific areas, many times if it's a freeway that's separating a comparable, you might be on 2 totally different sides of the spectrum. On this side of the freeway, you might have a home that's worth 1.5, and on this side of the freeway, you might have a home that's worth 4.2. And so you want to make sure that those homes are comparable in that sense as well. Even if it's within a half a mile, if it's across that freeway, you might be looking at a whole different world across that freeway. And so these are certainly things that you need to take into account, which brings up another point. The appraiser is a neutral third party. The appraiser is a professional licensed appraiser. They are hired by the bank and paid for by the buyer. And inside of the appraisal, you always want to make sure that you're working with an appraiser who knows the area. So even though as a realtor, I cannot control the appraisal in any way, shape, or form, I can't even talk to the appraiser about what the value is going to be at. To say, hey, listen, do you think you're going to have a problem with the value? That's not a right thing to do. I can't do that. And so what I can do is I will ask them, are you familiar with the area? Do you know the area? And I can also let them know, how do we get to this price? So whether I'm listing the property or whether I'm helping my buyer buy the property, we can let that appraiser know, this is how we got to the price, and this is how the area looks. This is how we got there. These are the comparables that we used. It's entirely up to you. You're the professional. These are the comparables that we used. And many times I don't necessarily expect them to use those comparables unless they're just spot on and there's no reason that they would not use the comparables. But I'm just trying to give them an idea of what happened to us getting to that price. How did we get there? So the appraiser is a neutral third party. And we do want to keep it that way because it keeps the market level overall. The appraiser does have the purchase agreement. So the appraiser knows the purchase agreement. They know how much the purchase of the property is. Inside the purchase agreement, they also see how much the buyer's putting down. Now, I'm not an appraiser, so I don't know everything else they take into account, but I do know that the appraiser is looking for properties that are comparable to the property that is the subject property. So the property that you're purchasing, the property that you're looking to sell or purchase when the appraiser comes out, they are looking for other properties that are like that subject property. Appraisers are great people. Appraisers really know what they're doing. One thing to pay attention to as you're going into the purchase or the sale of a property, especially if you're a buyer, you want to make sure that you have a really good idea of whether or not that property is going to have a hard time appraising. You, as an agent, I will be able to tell my buyers, yes or no, we should be fine with this. But that's by looking at the comparables, and that's by being able to have a solid idea of what the price should be and what the price is looking like in the area. How is this going? Right now, the market is a little bit slower and it's less buyers because interest rates are a little bit higher. And so this gives buyers the opportunity to have contingencies. It gives buyers the opportunity to sometimes have an appraisal contingency, for example, an inspection contingency if there's no inspections done. And so this is a great time for the buyers from the appraisal contingency perspective. If you like this video, please like, subscribe. If you have any ideas for videos, please let me know. I'm always happy to answer questions, and also if you have anything specific for videos, please let me know. I'm always here and happy to help. Have a wonderful day. Talk to you soon.